Silver Forecast Desk Brief. Live Newsroom. February 2026. This desk brief is not about today's price. It's about stress building inside the world's primary silver futures exchange, stress that becomes visible as soon as February 27th, when March 2026 delivery begins on COMEX. What follows is not conjecture. It's pattern recognition based on CME delivery data. Throughout all of 2025, every signal delivery month saw more silver demanded for physical delivery than the same month in 2024. Not rolled forward. Not quietly settled in cash. Physically delivered. That alone tells us the COMEX market is being used differently. Market participants are no longer primarily hedging price exposure. They are demanding metal. January makes that shift impossible to ignore. In January 2024, roughly 6.8 million ounces stood for delivery. In January 2025, that rose to 11.8 million ounces. In January 2026, delivery demand exploded to 49.4 million ounces. That is not a marginal increase. That is a structural break-in behavior. Now move to February. So far in February 2026, about 18.72 million ounces of silver have already been delivered, nearly matching all of February last year. But volume alone is not the most important signal. The smoking gun is participation. In February, almost all open interest has been called for delivery. That is highly abnormal. Under normal market conditions, only 5 to 10% of open interest stands for delivery. The rest rolls forward, offsets, or settles financially. That did not happen this time. Instead, participants behaved as if waiting carried risk. Which tells us something critical. Market participants do not appear confident that if they wait for a major delivery month, they will still receive metal. And that brings us directly to March. The major silver delivery months are March, May, September, and December. Those months are where the COMEX system is designed to absorb large delivery demand. Yet instead of waiting for March, delivery demand was pulled forward into February. That is not normal. It suggests urgency. Now look at the historical context. In March 2024, about 27 million ounces were delivered. In March 2025, that number surged to 80 million ounces. For March 2026, current open interest represents approximately 429 million ounces of silver. To be clear, not all of that open interest will stand for delivery. But even a fraction of that demand, layered on top of February's behavior, would represent historic strain on COMEX inventories. At that point, the system is forced into one of three outcomes. First, contracts are aggressively rolled forward into May. That delays stress, but it does not remove it. Second, cash settlement becomes necessary. That signals futures prices are no longer anchored to physical availability. Third, physical delivery fails. And if delivery fails, even selectively, confidence in the paper silver market suffers a permanent loss. This is where price discovery changes. If COMEX is forced to resolve contracts in cash or cannot deliver metal, silver is no longer priced by futures contracts. It is priced by who controls physical supply. And when price discovery shifts from paper to physical, it does not move in orderly steps. It reprices, often abruptly, and often to levels that cannot be modeled using prior market behavior. That is why February 27th matters. That is why March matters more. And that is why this moment is different. We will continue tracking COMEX delivery data daily, alongside Shanghai warehouse signals, as this unfolds. This is Silver Forecast.